The wealthy are taught to invest in a completely different way than the middle class and the poor. So, what's that's one of the big reasons why the rich keep getting richer and the poor and middle class stagnate at best or even get worse or fall down the economic ladder. We're going to talk about that and more in today's episode of the Secrets to Abundant Living podcast.
Welcome to the Secrets to Abundant Living podcast. Your guide on this journey is Amy Silvas, ready to unlock the keys to a life of true abundance. We're diving into everything from financial freedom and optimal health to meaningful relationships, geographic freedom, and everything in between. It's about creating a life rich in experiences, purpose, and joy. If you're ready for the secrets to an abundant life, hit that subscribe button now, and let's get started.
Hey everyone, welcome to the Secrets to Abundant Living podcast. It's been a minute since we've had a solo episode, so it's great to see you all. And gosh, the middle of March, wild. Time is going by quickly. But I recently read this article and I wanted to share it with you all because we talk a lot on this podcast, as you know, about living in abundance. Haha, that's the name of the podcast. But often the type of income that we have can facilitate being able to do what we want, when we want, where we want, with whom we want, for however long we want. And the biggest realization for me over 15 years ago was this eye-opening moment of, oh, not everyone earns their money the same way, let alone gets the same investment advice. And to see that play out has just been fascinating to me. And you know the old saying, right? If you want to go somewhere or achieve something, find someone who's already gotten there and understand how that worked or how that happened. Okay, maybe that's not the old saying, but you understand what I mean. If you want to be a great football player, hey, go find coaches or football players who have achieved what you're looking to achieve, right? So I like to study the wealthy. I want to understand the different rules that they're playing by. And hopefully you've realized by now they're playing by some really, really different rules. So let's talk a little bit about this. There is an organization called Tiger 21. We've talked about them before, but Tiger 21 is a group for ultra high net worth individuals, and they study how these people are allocating their assets, what their investments look like. And let me tell you, of course, the only reason that the ultra wealthy are ultra wealthy isn't just because of how they invest. There's a lot of other factors. So please understand what I'm saying, but we cannot discount the different education and therefore the different activities that the ultra wealthy take versus the middle class and the poor. So we're going to dive into that really deeply because I think this is important for you all to understand. The Tiger 21, they did a member asset allocation assessment. And that means of all the assets that they have, what are these folks investing in? And the asset class that has the highest asset allocation for these ultra high net worth people is private equity. So what's private equity? As a review, it's companies that aren't necessarily traded on the stock market, right? There are a whole bunch of companies that aren't necessarily quote unquote public. You can't buy their stock on the stock market, but you can sure invest in them. But there isn't, just this market out there that everyone can access. So private equity is number one. Number two is real estate, and that's at 25%. So private equity is 31%, real estate is 25%. That's not just their personal home. As you can imagine, that's not just their personal home. And then 23% is public equities. And then we have 9% at cash, 6% at fixed income, 2% at hedge funds, 2% at commodities, 1% at crypto. So how is this different? You can probably already tell from what the poor and the middle class are taught. Who wants to guess? The poor and the middle class are told to go to school, get a job, pour all your money into a 401k, right? That's your savings. Buy a house, not just buy a house, but pay off your house. So sink in a whole bunch of money into your house, maybe do some renovations, sink some money into that. pay your property taxes, pay your insurance, your repairs and maintenance. And then in your 401k, by golly, all the 401ks, for the most part, for the company that you work for, they allow you to do stocks and bonds, quote unquote traditional investments, right? So you got your owner occupied home, you've got your stocks and your bonds. Now, I'm not saying that you shouldn't do that. None of this is investment advice. You've heard me say this ad nauseum. I'm just giving education and talking through how interesting it is, how different the wealthy invest. And, we can speculate around that, but it's possible that the poor and middle class don't necessarily think that they have the the ability or the amount of money to invest. And that's a fair comment, right? You know, to invest in private equity, you often, not always, but you often need a bit more money than buying a stock. But there's also, as we talked about, there's crypto. Not all crypto is incredibly expensive. Commodities aren't all extremely expensive. I think silver is what, $85 an ounce right now. And then there's real estate, doesn't have to necessarily be millions and millions of dollars outside of one's home, right? It can be as little as $25 or $50,000. But I don't think the only reason that the poor and the middle class invest differently from the ultra wealthy is just what they have access to or the amount of money it costs to invest. I think most people don't necessarily invest in, I use that word purposely, invest in personal financial education, right? So they just hear tangentially, because our schools don't teach this, right? So they just hear tangentially, they go to their job and they're told, open your 401k and max that out, because God forbid you don't get your company match. That's a whole other story as to kind of the tricks that are played on people there. Get your company match, and you're diversified in your stocks, bonds, and mutual funds. That's diversification, right? She says sarcastically. I just think folks don't know what else is out there, what's accessible to them, and what diversification might mean. Have you ever thought about having multiple streams of income? Instead of relying on just one stream of income where you're trading your time for money, how would you like to free up more of your time and live a more abundant life? As a listener of the show, you're invited to attend one of our upcoming trainings where I'll give you an inside look into how you can add passive income and get all the other perks of recession-resistant real estate investing without the headaches of being a landlord. I'll also be sharing some hidden mistakes to avoid and the criteria I personally look for when evaluating potential investment opportunities. To reserve your seat for free, go to silviscapital.com/webinar. Again, that special link to reserve your seat for free is silviscapital.com/webinar. I look forward to seeing you on the training. And now back to the show. So there's this idea of traditional assets, stocks, bonds, mutual funds, one's current home. And then there's this whole world of alternative assets where you can invest in businesses like private equity, real estate, even gold and silver bullion are treated as alternative assets. So typically, the middle class has about 70% of their net worth in their primary home. Now, if you go to the ultra high net worth people, that's about 7.5% of their wealth is in their principal residence. What a wild discrepancy. Ultra high net worth are people that are $10 million or more generally. And then we look at, things like stocks, securities. That's a big portion of what the upper class, upper income, which is different than ultra high net worth. So the upper income is around 450K in terms of net worth, all the way up to 10 million or so. They have traditionally around 22%, I think, around in terms of their stocks and securities and such. And then we take a look at the alternative asset space. Middle class folks generally have around 8% of alternative assets like businesses, private equity, real estate. The upper income folks that are 500K to about 10 million have about a quarter, so 25% in these alternative assets. Then the ultra rich have over half their net worth in what we consider to be alternative assets. I'm shrugging my shoulders if you're not watching the video. I think there's something interesting to be studied. I'm not saying all of you all should go out and reallocate your assets. By no means. I'm not a financial advisor. I'm just talking about education here. But there is this idea of diversification. I was talking on LinkedIn about this, and there seems to still be quite a large gap, at least there, on this idea of diversification and non-correlated assets. Mathematically and statistically speaking, the stock market and now even the bond market move together. And that's fine. There's nothing wrong. I'm not saying there's anything wrong with that. What can become a problem is when one thinks one is diversified and one isn't. That's the thing. If your goal is diversification, I'm not saying it should be, but if it is, and then your financial advisor tells you you're diversified, but all you have are stocks and bonds, the definition of diversification is assets that move together. And some of us, like myself, not saying it should be you, want assets that don't move together. If my stocks and bonds tank, I'd like something else to be uncorrelated or negatively correlated and go up historically. And you can build a portfolio like that. I'm not saying you should, but you can. And often that involves alternative assets. So I suspect that's a very big reason why the ultra wealthy invest in alternative assets outside of the stock and bond market. Also, there can be better returns, not always. There might be higher risk. The ultra wealthy might be able to take higher risks because they have more money. That could be another explanation. I don't think there's one solid explanation that just, across the board, this is what all of this means. But I do think it's been great food for thought for myself and my family, and it might be for you to really understand what else is out there, why you haven't been told about it, how it might fit into your portfolio. And you may say, and you've heard me say this, but it's always a good idea to ask your financial planner how they're compensated. Oh, do they make money based on what they recommend to you? That's fine if they do. I'm not saying that they shouldn't, but human nature would dictate that might influence the types of things that some people recommend. So again, that's fine. They're trying to make some money. I have nothing against it. But you, as the person being advised, should understand how decisions are made. And like anything, with medicine, with your career, with anything, you should come to the table with some information so you can ask some questions. The experts are the experts. That's wonderful. But there's nothing wrong with you saying, hey, so how correlated is my portfolio? If I'm invested in stocks, how often in the past have all stocks moved together? Are there other asset classes that I can research and understand that when stocks take a dive, this other asset class goes up? It's a great place to start. Okay, well, this is all I've got for you all today, but I thought that Tiger 21 asset allocation report was really great food for thought. And starting off 2026, we're already a quarter through, if you can believe that, but upping your education and maybe just understanding the why behind some things. It's exciting. I hope it is for you all too. Do me a favor. If you haven't left a review on YouTube or a comment on Spotify, on Apple Podcasts, I would be incredibly grateful. We put a lot of effort into these podcasts, and to have a review from you all helps us get exposure to new people, to help new people understand this space and go on their financial journey as well. All right. Thank you all so much. We'll see you on the next episode. Bye for now.
Thank you for joining us on another episode of the Secrets to Abundant Living podcast. We hope you found inspiration and valuable insights that will empower you on your journey towards abundance. If you enjoyed today's episode, don't forget to subscribe, rate, and leave a review. Your feedback means the world to us, and it helps others discover the secrets to an abundant life too. Stay connected with us on LinkedIn, Amy Silvis. Keep striving for your goals, nurturing your relationships, and embracing the adventure that is life. Until next time, we wish you an abundantly fulfilling day.